Assalamualaikum and good morning to Madam Nur Mazatul Akmal binti Saidi. We are from L1 class. Our title is Case Study 1. I am Wan Muhammad Hafizi bin Wan Mustafa and my other member which is Muhammad Zikri bin Abdul Wahab, Michel Rabai anak Sulin, Anis Sakinah binti Mustafa, Nurul Hazwani binti Syahul Hamid and Nur Umi Atirah binti Bilnaza.
The importance of accounting is keeping record. One of the bigger advantages of accounting is how it allows business to keep systematic record of their financial information. Accounting is also essential for internal users of the organization. Internal users may include people who plan, organize, and run the organization. Accounting activity can comprise investor and creditor at home or abroad to invest in the company. Investor and creditor rely heavily on accounts to assess the financial stability and viability of the internal before investing or extending credit. Accounting is essential for doing financial tracking in a company. The accounting system will help in tracking financial transactions, income, expenses, assets, and liabilities.
This is a journal that we have done and follow step 1 and step 2 by analyzing the transaction and deciding the accounts to be used. The second is ledger that we use step 3 by recording the transaction in ledger account. This ledger account have capital account, rent account, purchase account, creditors account, service account, debtors account, cash account, wages account, owner's drawing account, unearned revenue account, utilities account, salary account, and computer account. Next, we go to the trial balance. This image shows the Indah Pelangi Senior Berhad trial balance at 21 October 2020. Now, we go to the statement of profit and loss. Statement of profit and loss. Indah Pelangi Senior Berhad trading and profit and loss account for the end 21 October 2020. Service 59,000 in column credit, less cost of goods sold. Opening stock is 0 in column debit. Purchases is 20,000. The less cost of goods sold is 20,000. Less closing stock is 0. 59,000 minus 20,000 equal to 39,000. 39,000 is gross profit. Less expenses in column debit. Salary 700, rent 15,000, wages 6,200, and utilities 15,600. Total all the expenses, and the total is 27,500. The 29,000 minus 27,500 and the total for net profit is 11,500. And the last one is balance sheet statement. Indah Pelangi Senior Berhad balance sheet of 21 October 2020. Fixed assets computer 100,000. Current asset for cash and debtors. The cash is 540 for 6,000 and debtors 17,000. The cash minus debtors equal to 516,600. Less current liabilities. Creditors 5,600 minus unearned revenue 40,000 equal to 14,500. the 561,600 minus 45,600 and total 516,000. Working capital finished by capital is balance 600,000. Net profit 11,500 minus 500 and the total is 11,000. The balance for capital have to plus 11,000 and the total is 611,000.
Next, we move to the usefulness of the statement profit and loss. The profit and loss account statement are a valuable tool for businesses as it allows them to monitor their performance over time and compare it to that of their competitor or prior accounting periods. The company can determine whether it is growing or shrinking by comparing the profit and loss account statement from various time periods. For instance, a growing revenue stream combined with declining expenses indicates growing firm profitability. However, it indicates that the company is losing money if income is declining and expenses are rising. Second, the profit and loss account report divided the revenue and costs that have been generated and achieved by the business in a given period. The company can find opportunities for cost cutting or improvement by examining the sources of income and the different kind of expenses. For instance, the company can determine which of its several revenue streams such as product sales, service fees, or advertising money is more profitable than others. Thirdly, using historical data and presumptions, the profit and loss statement assists the company in projecting its future revenue and expenses. One popular technique for financial forecasting is to project future income and expenses, which combine past data and estimates to predict how a business will perform in the future, which is to gather and examine the company's historical revenue and spending data for a given time frame, such as a quarter or a year. Lastly, the profit and loss account statement aids in the company's communication of its financial outcomes to all relevant parties, including creditors, investors, consumers, and regulators. A business net profit or loss for a given period is displayed in the profit and loss statement. It is a crucial document that informs different stakeholders about the company's financial performance.
First and foremost, the balance sheet statement offers a glance into the situation of the company's finances. It displays the amount invested in the company equity as well as the assets and liabilities it possesses. This provides a clear image of the company's worth and financial situation at a certain moment in time. A balance sheet statement, for instance, can display the amount of cash, inventory, real estate, equipment, and other assets as well as the amount of debt, account payable, taxes, and other obligations the company has. Second, the balance sheet statement aids in evaluating the company's liquidity and solvency. The capacity of the company to settle its long-term debts and commitments is known as solvency. The capacity of the company to cover its immediate cash needs is known as liquidity. The ratios of assets to liabilities, current assets to current liabilities, and available cash and cash equivalent are displayed on the balance sheet statement, which aid is measuring these factors. A balance sheet statement, for instance, can display the amount that the company owes to its lenders, banks, suppliers, or bondholders, as well as the amount that it can repay them using its asset, cash, marketable securities, or account receivable. Thirdly, the balance sheet statement aids in assessing the company's financial leverage and capital structure. The proportion of debt equity that a company uses to fund its operation is known as its capital structure. Leverage in finance refers to the utilization of debt to raise the possible return on equity. By displaying the percentage of debt and equity and the total liabilities and equity, the percentage of interest-bearing debt to the total asset, and the effect of debt on the risk, profitability of the company, and the balance sheet statement facilitate the analysis of these variables. Lastly, the balance sheet statement aids in informing different stakeholders about the company's financial performance and current position. Those with an interest or concern in the company, including creditors, investors, consumers, and regulators, are referred to the stakeholders. The balance sheet statement, which displays the company's assets, liabilities, and equity at a certain points in time, aids in informing these stakeholders about the financial performance and state of enterprise.
Conclusions. Preparing financial statement in accounting involves 5 distinct processes: generalizing, posting to the ledger, creating a trial balance, generating an income statement, and producing a balance sheet. The goal of this financial statement was also established to ascertain the influx and outflow of the money and profit. By doing a thorough examinations of their expense ratios, growth rate, and profit margins, the organizations may evaluate its own performance and identify specific areas of strengths and weakness. Through the assessment of different sources of income and categories of expenditure, the organization can pinpoint areas that can be enhanced or where costs can be reduced. Analyze the primary factor. This technique is advantageous for profit and loss since it allows the organization to proactively plan, budget, and allocate resources effectively. The document is essential for informing various stakeholders about the company's financials and performance. The profit and loss account serve as a useful tools for monitoring the company's success over time and making comparison with competitors or previous accounting periods.